All right, today we're going to break down a financial tool that was built to solve a very specific problem for retirees. That search for a happy medium between risky growth and savings that are safe but, well, kind of slow. And really, it all boils down to this one big question, doesn't it? For anyone saving for retirement, this is the dilemma. How in the world do you keep your money growing without putting the nest egg you've worked so hard for at risk in the market? It really feels like you're stuck between a rock and a hard place. On one side, you've got stocks, right? The potential for amazing growth is there, for sure, but so is the very real stomach-churning possibility of a big loss. And on the other side, you have these super safe options like CDs. Your money's not going anywhere, but the growth is so low it might not even beat inflation. So this tension, this constant tug of war between needing your money to grow and needing it to be safe, that is the exact problem that a product called a fixed indexed annuity, or FIA for short, was designed to try and solve. Okay, so let's get into it. What exactly is this thing that claims it can offer a way out of that classic saver's dilemma? So the official definition here sounds a little dense, I know, but let's put it in plain English. Think of it like a contract, a deal you make with an insurance company. You give them a chunk of money, and in return, they promise to protect that initial investment, your principal, but they also give you the chance to earn some interest based on how a market index, like the S&P 500, performs. And this is absolutely the most important part to get. You are not actually invested in the market. Your money is with the insurance company, which means it's shielded from any of the actual downturns in the index it's linked to. And this right here perfectly illustrates that protection. It's called a 0% floor. So if the market index your annuity is tracking has a really bad year, down 10, 20, 30%, the interest that gets credited to your account is just zero. Not negative 30. You don't lose your principal. You don't lose any of the gains you've already locked in. In this case, zero is your hero. So that brings up the obvious question, right? If you're not actually in the market and your money is protected from losses, how does it actually grow? Let's pop the hood and see how the engine works. It all works on this really simple annual cycle. Once a year, on your contract's anniversary, the insurance company looks at how the index did. If it was a good year, they credit interest to your account. And here's the really powerful part. Those gains are now locked in. They become a new, higher floor for your account value. They can never be lost in a future downturn. Then, the whole process just resets for the next year. Okay, so here's the trade-off. That amazing downside protection, it's not free. There's no free lunch, right? In exchange for that 0% floor, there's a ceiling on your potential gains. The insurance company does this in a few ways, maybe with a cap, which is just the maximum interest rate you can earn in a year, or a participation rate, which means you only get a percentage of whatever the index gained. This is how they pay for that peace of mind. Now, when you start looking at different FIAs, you're probably going to see a big choice you have to make right up front. Should you go for a version that has an upfront bonus or one that doesn't? An upfront bonus that instantly boosts your account value. That sounds incredible, right? But the question you have to ask yourself always is this: is it really free money? And spoiler alert, the answer is pretty much always no. And you can see why right here. The cost of that bonus is usually paid for with lower growth potential over the long haul. So yeah, the bonus version gives you a higher number to start with, but the no bonus version, it'll probably have higher caps and participation rates, which means its growth engine has more horsepower over the life of the contract. And there's one more little catch you got to know about. It's called bonus recapture. See, these contracts have a surrender period, a set number of years where you'll face a penalty if you pull your money out early. And if you do that, the insurance company can actually take that bonus back. It's basically their insurance policy to make sure you stick around for the long term. Okay, so since these are definitely long-term tools, it is so important to understand the rules of the road. Let's talk about how you can actually get to your money. Now, even though there are those penalties for pulling out too much too soon, these contracts aren't some vault that's locked up tight. They actually have features built right in that are designed to give you access to your money when you need it. So they come with a few different ways to get your cash without a penalty. The most common one is a yearly withdrawal, usually up to 10% of your account value. That can be a great source of retirement income. They also play nice with things like required minimum distributions from your IRA. And a lot of them have waivers for big life events, like needing nursing home care or making sure your beneficiaries get the money if you pass away.
So after we've looked at how it works, the trade-offs, the rules, it all comes down to the big question: who is this thing actually for? Is it right for you?
Look, an FIA is definitely not for everyone. It's not for the person trying to squeeze every last drop of growth out of the market. It's for the saver who puts protecting their principal above everything else. It's for someone who's tired of tiny CD rates but gets anxious just thinking about market swings. It's really a tool for a specific slice of your money that you have a long-term plan for. It's designed to just smooth out the ride. And at the end of the day, that brings us right back to where we started. Understanding a product like a fixed indexed annuity isn't about finding some kind of magic wand. It's about understanding the trade-offs, so you can answer this question for yourself. In your own financial plan, what's the right balance between growth and protection?